Multifamily is facing a crossroads due to three major trends in the market: rising interest rate, an unprecedented wave of new deliveries, and the maturation of historically high volumes of loans. Buyers and sellers are both adapting and trying to discover realistic market pricing in this new normal. However, comparisons to pre Great Recession units under construction are not analogous due to a significant change in the type of multifamily properties being built today. Before the mid 2000s, new multifamily developments were mostly garden style apartments with construction timelines between 12 and 18 months, depending on the location. Leading up to the Great Recessions, infill locations, both urban and suburban, became highly coveted, with mid and high rise developments dominating the units under construction. Today, mid and high rise buildings remain the majority of new developments, and these types of buildings require double to triple the construction time compared to garden style properties. Thus, while the number of units under construction looks noticeably elevated, the delivery of units is spread out over a range from 1 to 3 years. For example, some high rise projects currently under construction won't deliver until 2025. That's why, even with 1.04 million units under construction, the delivery schedule will be much more spread out than historically seen. 519,000 units projected for delivery in 23, excuse me, and 476,000 in 24. In addition, 20 markets are projected to hit new record deliveries in 23, with the Sunbelt locations making up 12 of those markets. One market in particular stands out: Austin, which expects 18,000 new units to be delivered this year, more units than Atlanta, despite having half the inventory. These records deliveries, combined with weak demand, put a number of these 20 markets at serious risk of worsening fundamentals by the end of the year. However, there is potential light at the end of the tunnel. As the supply hits a total this year not seen since the mid 1980s, the rising interest rate environment, combined with a pullback in construction lending, has left some developers unable to move forward on proposed projects. With fewer projects moving forward, we could begin feeling a meaningful pause in delivery towards the end of 24 and into 25. This pause would be very helpful in allowing many overbuilt Sunbelt markets to soak up the current supply overhang and return to an equilibrium a little bit quicker. The rise in the overall national vacancy rate, nonetheless, doesn't tell the whole story playing out across different price points of the sector. 4 and 5 star vacancy and 3 star vacancy have both risen by 250 basis points over the past 6 quarters, but for different reasons. 4 and 5 star vacancy has borne the brunt of its rise due to oversupply, while 3 star vacancy has risen due to the impact of higher prices and economic uncertainty. In the first quarter, 4 and 5 star absorption totaled 45,000 units versus 72,000 luxury units completed. This caused a 20 basis point rise in the 4 and 5 star vacancy rate to 8.7%. In the middle price properties, elevated inflation, and significant rent increases in 21 and 22 are forcing some 3 star renter households to find alternative housing situations, such as returning home to their parents or finding a roommate. Additionally, economic uncertainty continues to hold back household formation, dampening middle market demand. Together, these economic forces push 3 star vacancy from 6.1% to 6.4% over the past 6 quarters. Now, if you're in need of an experienced commercial real estate broker, it can be reached at 281 222 0433. Appreciate your time and have a good day.